Hey everybody, the Fed is raising interest rates. What does that mean for the housing market? What does that mean for you? Stick around, that's what we're going to talk about. Let's get into it. So, the Fed, or the Federal Reserve, is the central bank in America that basically dictates monetary policy in the US. They raise and lower interest rates, they monetize the debt that the government issues. And that's a whole nother video, but they have a huge hand. Just know that they have a huge hand in the markets of the United States. They meet 8 times a year to discuss policy, and one of those is in March. It just happened mid-March. And so this is a Bloomberg article talking about how they're raising interest rates. They're going to get more aggressive, meaning they're going to raise interest rates faster than previously thought. And this is just a little snippet from this article. Fed Chair Jerome Powell, he's the head of the Federal Reserve, originally nominated by Trump, renominated by Biden. So Jerome Powell and his colleagues shifted from a long-standing preference for a slow and gradual interest rate increase to front-loading policy with a half-point hike on the table in May and more to come. So they just raised interest rates this month, 25 basis points. And 25 basis points is the same thing as saying they raised interest rates 1/4%. So 25 basis points is equivalent to 1/4%. 100 basis points would mean that they raised interest rates 1/2%. What this is just telling you is that originally they were going to do it slower, but they've been getting a lot of pressure from basically everyone in America saying that this has got to get under control. Inflation is running hot. There shows no signs of slowing down. And the main tool that the government has and the Fed has to get inflation under control is to raise interest rates. This makes borrowing money more expensive. You have to pay more interest every time you take out a loan, and that disincentivizes people disincentivizes people from borrowing more and more money. When interest rates are low, you can basically pull out as much money as you want. You have to pay back the principal and a small amount of interest. But as you will see shortly, that I'm going to show you, as they raise interest rates, the cost to borrow money increases, and so people spend less money, thereby reducing inflation. So I just wanted to show you this. So this is the housing market ever since 1963. So Q1 1963 all the way till Q4 2021. And there's 3/4 or 4 quarters in fiscal year. If you ever see someone see a fiscal year, it's just 1 year, 12 months. So this broken down financially into 4 quarters. So every 3 months. So the first 3 months of the year, January, February, March, is the first quarter, and so on. So this goes from Q1 1963 all the way until Q4 2021. And so a house used to cost about 20 grand, and now it costs, the latest estimate, average sales price of houses sold in the United States, the latest data we have is $477,900. And give me 1 second. Oh, let me just pull this up. What this is inversely related to the interest rates. So if you look at interest rates, and one of the standards that people look at is the 10-year yield. And this is just a 10-year interest rate. So if you take out a loan, this is the standard amount you'll have to pay back. And if you go to max, this will only go back to 1985. But you can see as housing prices, remember that other chart, it goes up and up and up and up. These interest rates have gone down and down and down and down and down. And so people have been able to afford more house or more money. They've been able to purchase houses at a higher cost because these interest rates have come down. And so what I want to show you is a little chart I made. And that's this little guy. And this just shows where housing prices are and where they could possibly go if housing prices increase while the Fed is raising interest rates. So that housing price increase that I showed you, that chart, government data, and this was the price of a house in January of 2020. So right before everything started to get crazy, right before housing prices started to skyrocket, this was the average selling price of a home in January of 2020, $384,600. And I took a down payment of 5%, which you can get some government subsidized loans for, you can put down 2 or 3%. So I'm being generous here, which actually maybe deflates the number a little bit. So I'm not going above, I could say, 10, 20% down payment, but I think I'm being generous by saying 5. Anyway, the average interest rate on a 30-year fixed rate mortgage, and a 30-year fixed rate mortgage just means it's a 30-year loan. So you have to pay back the entirety of it within 30 years. And over that period, you're going to pay 3.7% annually. And that compounds to make a big difference. So 384,000, 5% down payment, 30-year loan. Oh, and fixed rate just means that the interest rate never changes. You can have either a variable loan or a fixed rate loan, and a variable rate loan will go up and down depending on where the Fed adjusts interest rates to. So I'm just going off a fixed rate loan to make it easier. But 3.7% at 384 back in 2020 would put you back $2,100 a month. And at the end of your 30 years, you would have ended up paying $721,000 for this house. This column is where we are at today. The average sale price for a house, this is that chart I was showing you, is $477,900. And the same 5% down payment would be a little bit more because the price of the house is more. Same 30-year loan, but the average interest rate today is 4.85%. And not only, this is a huge increase in the housing cost, but this also makes a huge deal as well. And so the price increase just in the last 2 years for the same house went up 36%. You were paying, after 30 years, $721,000 for that house. Now you're paying $983,000 for this house. And this is the difference between this guy and this guy. So this column 1, I can just put interest total. This is how much money you will be spending on interest over the entirety of your loan. Because the interest rate is higher, you're going to pay more in interest. Now I just made these columns to show where housing prices could go if they continue to go up. If the Federal Reserve continues to hike rates more aggressively, this is potentially where the interest rate is going to go when you go to apply for a home loan. And so you can see in the monthly payments here that you go from $2,100 for this house, and we're talking about the same house. This is just the average selling price of the house. So the same house that costs $384, and you're paying $2,100 a month for. If it goes up to 505%, you're now paying basically $1,000 more per month for 30 years. So that takes this $721,000 payment and increases it to $1,050,000 basically. Now, if you just keep going down this line, 515,000 at 6%, you're going to end up paying $3,400 a month. 525 at 7%, you're going to pay $3,800 a month, and 530,000 with 8%, you're going to be paying $4,100 a month. So almost double what you would have been paying in January of 2020. And why this is significant, what people are talking about, is eventually there is going to be a breaking point within here, right? Because right now, a lot of people I know are paying for houses. And actually, quick story, I know someone, and I don't want to say exactly who they are, but they have a daughter who is applying for or trying to buy a house. She just got married in the Maryland area, and this is generally a little bit more pricey, but they just offered $105,000 over the asking price of a $700,000 house. So I think the seller was asking like $680,000, and they ended up offering 785. I remember it being 105,000 over the asking price, and they got denied. So people are paying out the wazoo for these houses. And eventually there is going to be a breaking point within here because people just aren't going to be able to afford these homes. And that is where the issue comes in. How far can the Fed raise interest rates before the housing market crashes? And no one knows, if you had told people back in January 2020 that we could shut down the economy for, a year and a half and housing prices would soar, people would have told you that you're crazy. So this might continue. But from what I've heard, and you can, I guess do your own research, but from what I've heard from people that I trust, there's going to be a breaking point somewhat soon. This can't continue forever because your average person cannot afford $4,100 a month right now. This just can't happen. This can't happen. This number, this row, in my opinion, can't happen. I wouldn't be able to afford that. No way. And so this last column, I just wanted to show you is if we do end up at this 8% time frame and everything crashes and we have to come back to an equilibrium at some point, because eventually, nothing has changed with the price of my house. I bought my house in 2019, so I got lucky, but the value of this house has not really actually changed. We haven't put, a bunch of money into it. It's just the value has gone up because we're in this crazy market. So eventually we're going to come back down to an equilibrium point. And in order to get these payments the same, right? So you have $2,000 up here, you basically have $2,000 up here, you have $721 up here, and you have $717 down here. So at 8% interest, right, you'd have to bring this housing price cost down to $240,000, down from $384, right? So you go all the way up here. So imagine if you bought your house in this area, right, 525, maybe 530, and then all of a sudden it crashes and it goes down more than 50%, down to 240, because that's where it would have to go to get back to this level. So that is a quick video on where the housing market is, why these interest rates affect the housing market so much. And you can see right here, the total payment is one thing, but if you just look at, what are you budgeting for your house every month, this increase is huge. It's like 2, almost 3 again, 35, 38, 4. It's just not sustainable. Can't just keep going up forever. So eventually this is going to correct, just nobody knows when. But that is why people are talking about interest rates being tied to the housing market. And that's an explanation on why it's so important. Let me know if you have any questions. I hope this was helpful. Like and subscribe. I would appreciate it. And until next time, keep it simple, stupid. Don't overcomplicate things. And I hope you enjoyed. Take care.